Welcome to this YouTube channel. In this video we are going to talk about building a diversified portfolio for long-term growth. So before starting the video, please like this video and subscribe this YouTube channel for future updates. When the market is performing well, it appears to be next to impossible to sell a stock at a price that is lower than the one at which you originally purchased it. But, because there is no way for us to know for certain what the market will do at any given time, we must never overlook the need of maintaining a diverse investment portfolio regardless of the state of the market. The investment community preaches the same thing the real estate market preaches for buying a house. Location, location, location. To put it another way, you should never put all of your eggs in one basket. When it comes to establishing an investing strategy that mitigates potential losses in a bear market, the investment community preaches the same thing. This is the primary argument that underpins the concept of diversification. What does it mean to diversify? Diversification is a rallying cry for many people working in finance, including individual investors, fund managers, and financial advisors. It is a method of management that involves combining many types of investments into a single portfolio. The concept of diversification is predicated on the assumption that a wider range of assets would result in a greater return. It also implies that investors will experience less risk if they diversify their portfolios and invest in a variety of vehicles. 5 methods to help you diversify your investment portfolio. The idea of diversification is not a recent one. With the benefit of hindsight, we are in a position to analyze the gyrations and responses of the markets when they began to falter during the dot-com bubble burst, the Great Recession, and again during the COVID-19 recession. It is important to keep in mind that investing is an art form and not a reflex, and that the best time to practice disciplined investing with a diverse portfolio is before diversity becomes an absolute requirement. When the typical investor finally reacts to the state of the market, 80% of the damage has already been done. In this market, more so than in most others, the best defense is a strong attack, and investors who have a well-diversified portfolio with a time horizon of at least 5 years should be able to weather the majority of storms. Here are 5 suggestions that can assist you with diversification. Number 5. Share the good fortune. Although stocks provide a lot of potential benefits, you shouldn't invest all of your money in a single company or industry. Think about starting your virtual mutual fund by purchasing shares in a few companies that you are familiar with, have faith in, and possibly even make purchases from regularly. Yet, stocks are not the only item that should be taken into consideration. You might also put your money into exchange-traded funds, ETFs, real estate investment trusts, or commodities REITs. Also, don't limit yourself to your home turf all the time. Go outside the box and think on a global scale. By doing things this way, you'll reduce the overall risk you take, which may result in greater potential profits. Some would argue that investing in what you know will leave the average investor too strongly focused on retail, yet knowing a firm, or consuming the goods and services it provides, and be a healthy and wholesome approach to this segment of the market. Nonetheless, you should avoid the error of going beyond what is reasonable. You must limit yourself to a portfolio that can easily be managed. When you don't have the time or money to keep up with everything that's going on, it's not worth it to invest in 100 various kinds of automobiles. Make it a goal to restrict the number of investments you have to between 20 and 30. Number 4. Think about investing in index or bond funds. You might want to think about including some index funds or fixed income funds in the portfolio as well. Adding assets to your portfolio that track multiple indices is a great way to diversify your holdings for the long term while yet maintaining a high level of liquidity. You can further protect your portfolio against the risk of loss caused by fluctuations in the market and uncertainty by including certain fixed income investments. Because the goal of these funds is to replicate the results of broad indexes, rather than investing in a particular industry, they attempt to replicate the value of the bond market. These funds typically come with cheap costs, which is even another advantage of investing in them. It will increase the money you have available. Because of the requirements for managing these funds, the administration and operating costs are kept to a bare minimum. The fact that index funds are passively managed is one of the characteristics that could work against them. Investing without actively participating in the process typically results in lower costs, although it may not be the best strategy in less competitive markets. For example, active management can be advantageous in fixed income markets, particularly during adverse economic situations. This is especially true. Number 3. Continue to invest in your portfolio. Maintain a consistent rate of growth for your investment portfolio. You should use dollar-cost averaging if you have $10,000 to invest in something. This strategy is utilized to assist in leveling out the peaks and valleys that are produced by market volatility. By investing the same amount of money over some time, as recommended by this tactic, you can reduce the amount of risk associated with your investments. Using dollar-cost averaging, you choose a particular portfolio of securities and put a set amount of money into it regularly. If you use this technique, you will buy more shares when the price of the stock is low and fewer shares when the price of the stock is high. Number 2. Recognize when it is time to leave. Both buying and holding and dollar-cost averaging are considered to be effective investment methods. The fact that you have your investments set to run automatically does not mean that you should disregard the market dynamics that are at play. Maintain a current status with your investments, and monitor any changes that may occur in the general state of the market. You are going to want to stay current on the status of the businesses in which you have invested your money. When you do this, you will also be able to determine when it is the right time to cut your losses, sell, and move on to the next investment in your portfolio. Number 1. Always keep a keen eye on the commissions. Understand what you are getting in exchange for the fees that you are paying if you are not the trading type of person. Some businesses charge a fee every month, while others only charge costs on individual transactions. These things can certainly build up and eat away at your bottom line if you're not careful. Be mindful of both the price that you are paying and the value that you are receiving in exchange for it. Keep in mind that the one that costs the least is not always the best one. Always make sure you're up to speed on any adjustments that may have been made to your prices. When an investor diversifies their portfolio, they are less likely to place all of their eggs in one basket, with the expectation that even if one stock, sector, or asset class suffers, others may fare better. This is especially the case if the assets or securities that are owned do not have a strong correlation with one another. Mathematically speaking, diversification lowers the overall risk of the portfolio, without lowering the expected return on the investments. Are index funds well diversified? An index fund or exchange traded fund ETF is one that, by definition, duplicates an index. Depending on which index you use, it can have a higher degree of diversification than other investments. For example, the S&P Wink with tongue sticking out 500 contains more than 500 different stocks, whereas the Dow Jones Industrial Average only contains 30, making it significantly less diverse. Even if you have an investment in an S&P Wink with tongue sticking out 500 index fund, this does not guarantee that your portfolio is diversified. You should also include other low correlation asset classes, such as bonds, as well as modest allocations to commodities, real estate, and alternative investments, amongst other things, in your portfolio. What do you think about this video? Do let us know in the comments section below. If you enjoyed this video and want to hear from us again, be sure to hit that subscribe button before you go.